Hey everyone, welcome back to Corporate Decoder, the place where we dig into the details of big companies. Today we're looking at Waterstone Financial, and let me tell you, this report has more twists than a water slide, especially when it comes to how the top dogs get paid. So what's this all about? It's Waterstone Financial's proxy statement, basically a document that tells shareholders what's on the agenda for the annual meeting. This includes things like electing directors, approving the company's choice of accounting firm, and even giving an advisory vote on executive pay, letting shareholders voice their opinion, even if it's not binding, on whether the big bosses are getting paid fairly. First up, they need to elect a director. Alan Bartel is up for re-election. Then they want to get the shareholders to officially agree with their choice of Forvis Mazars, an accounting firm, as their independent auditor. Finally, and this is always a fun one, they want shareholders to give a thumbs up or down to the way they're paying their executives. Let's talk about who owns this place. Dimensional Fund Advisors and BlackRock each own around 9% of the company's stock, while Principal Trust Company, as trustee for employee plans, holds a significant 12%. It's always good to know who the major players are, as these big shareholders can have a lot of influence. Looking at the insider ownership, the directors and executive officers as a group control about 74% of the shares. Douglas Gordon, a director, owns a substantial chunk himself, around 3.5%. This shows some pretty good alignment between management and shareholders, since their wealth is literally tied to the company's success. Now, who decides who gets to be on the board? That's the job of the Nominating and Corporate Governance Committee. They look for qualified people, check if the board members are independent, and make sure the company is following good governance practices. It seems Waterstone values diversity on its board. They consider education, experience, skills, and perspectives when picking nominees. They also use a skills matrix to make sure they have the right expertise around the table. Here's a little quirk: if someone owns more than 10% of the company's stock, they might not be able to vote all their shares. There's a limit to avoid a single person controlling everything. The audit committee is a very important one because it is in charge of the integrity of financial reporting. The committee has meetings, consults with the company's accounting firm, and makes sure all the financial disclosures are correct. The board is very certain that every member of the audit committee knows what they are doing, especially the chair, Mr. Hansen, who is called an audit committee financial expert. Speaking of accounting, the company wants shareholders to ratify or approve their choice of Forvis Mazars as their independent accounting firm. The previous firm, Clifton Larson Allen, decided to stop providing certain audit services. No disagreements were reported between Waterstone and Clifton Larson Allen when they parted ways. Waterstone paid Forvis Mazars around $390,000 for audit fees last year. Here's where things get interesting: executive compensation. Waterstone wants to pay its executives in a way that attracts and keeps talented people, motivates them to do great work, and aligns their interests with the shareholders. The compensation includes salary, short-term incentives or bonuses, stock awards, and benefits. To make sure things are fair, the compensation committee uses an independent consultant, is made up of only independent directors, and sets stock ownership guidelines for the top executives. They also have clawback policies, which means if an executive does something wrong, the company can take back some of their pay. The shareholders get a say on pay vote, so they can voice their opinion on whether the executives are getting paid too much, too little, or just right. Last year, over 91% of the votes cast were in favour of the compensation plan. The committee keeps this in mind for future decisions. How does Waterstone know how much to pay its executives? They look at what similar companies are paying. This year, the compensation committee is looking at peer financial institutions of comparable capitalization. The company has clawback policies that allow them to recover bonuses and incentive compensation if the company has to restate its financials due to errors. This makes sure that executives don't profit from mistakes. The biggest piece of the executive compensation pie is the base salary. It's the set amount they get paid no matter what. For 2024, the CEO, William Bryce, got a base of around $426,000. The chief financial officer, chief retail officer, all got base salaries in the $250,000 set, $300,000, $300,000. Range to forfeit officer all got base salaries in the $25,000 to offer, all got base salaries in the $50,000, $300,000 range. Then there is the annual incentive plan, a plan that awards cash incentives for yearly performance. A few important metrics were looked at in order to determine this payment. One of them was the community banking segment pre-tax income. In the end, the pre-tax income did fairly well and ended up at 118.7% of the target. This and other performance statistics are looked at when determining the bonus. CEO Bruss got around $167,000 in incentive pay, while the others got between $88,000 and $106,000. To have all the executives share a common goal, Waterstone does also offer equity-based compensation, mostly restricted stock. If the company does well, they do well. If not, not. For the executives to get their shares of stock, they need to be employed for at least 3 years, and also Waterstone needs to hit certain goals. The main factor of consideration here is the return on average assets over 3 years. Looking to give executive shares for good performance, CEO Bruss had an award of around $42,000. For other executives, the range was around $25,000. The actual shares each executive has depends on how well Waterstone does with return on average assets in a 3-year term. The compensation committee stated that it reviewed the executive payment plans and is happy with the current plans and strategy. The current members of the compensation committee are Ellen Bartel, Patrick Lawton, Stephen Schmidt, and Derek Tyus. Now, how does all this compare to the average worker at Waterstone? Well, the CEO made about 10.7 times what the median employee made. The median employee made about $66,000, while the CEO made around $714,000. The proxy also has this information about CEO pay versus how well the company did. This is mostly based on return on assets over the period and how the stock performed. The proxy ends with describing that the compensation is set in a way that aligns with company performance as well as with attracting talented employees. The best financial measures to show the impact are the return on average assets, the earnings per share, and the total shareholder return. There are a few side notes such as that Jeffrey Meganis, the president and CEO of Waterstone Mortgage Corporation, has an employment agreement guaranteeing him certain payments and benefits if he's terminated without cause. To make sure there are no shenanigans going on, all insiders, such as directors and officers, are required to report their stock ownership to the SEC. Waterstone said everyone complied with all these filling requirements. Like any company, Waterstone's directors and officers also do business with the company. They want to make sure that these people are not getting better deals. Finally, Waterstone believes in diversity and provides training programs to its employees. Benefits include medical, dental, and training programs. So what's the take on Waterstone Financial? Well, on the plus side, they have a lot of insider ownership, which means that management's goals are aligned with yours. They also have clawback policies, which keep the executives honest. The executive payment strategy is also something that most shareholders agree with. However, the report does state that a vast majority of the executive payment strategy focuses on stocks. So if there is an economic downturn or Waterstone somehow messes up, the executives will be paid less. So that is a strength and a weakness. Overall, Waterstone is pretty stable. The executives are well aligned and everyone is following the required regulations, such as the regulations requiring insider filings to the SEC. Thanks for watching. If you enjoyed this video, don't forget to like, comment, and subscribe for more deep dives into the world of corporate finance.